The tendency of the rate of profit to fall is a hypothesis in economics and political economy, most famously expounded by Karl Marx in Chapter 13 of Das Kapital, Volume 3. Although no longer accepted in mainstream economics, the existence of such a tendency was more widely accepted in the 19th century. Economists as diverse as Adam Smith, John Stuart Mill, David Ricardo and Stanley Jevons referred explicitly to the TRPF. They differed in their explanation about why the TRPF might occur. In his 1857 Grundrisse manuscript, Karl Marx called the tendency of the rate of profit to fall the most important law of political economy, and sought to give a causal explanation for it, in terms of his theory of capital accumulation. The tendency is already foreshadowed in Chapter 25 of Capital, Volume 1, but in Part 3 of the draft manuscript of Marx's Capital, Volume 3, edited posthumously for publication by Friedrich Engels, an extensive analysis is provided of the tendency. Marx regarded the TRPF as proof that capitalist production could not be an everlasting form of production, since, in the end, the profit principle itself would suffer a breakdown. However, because Marx never published any finished manuscript on the TRPF himself, because the tendency is hard to prove or disprove theoretically, and because it is hard to test and measure the rate of profit, Marx's TRPF theory has been a topic of controversy for more than a century. Smith, Ricardo and Marx on the TRPF. In Adam Smith's TRPF theory, the falling tendency resulted from increased competition which accompanied the growth of capital. Intensifying competition itself would drive down the average profit rate. Criticizing Adam Smith, David Ricardo argued that competition could only level out differences in profit rates on investments, but not lower the general profit rate as a whole. Apart from a few exceptional cases, Ricardo claimed the average rate of profit could only fall if wages rose. In Das Kapital, Karl Marx criticized Ricardo's idea. Marx argued that, instead, the tendency of the rate of profit to fall is an expression peculiar to the capitalist mode of production of the progressive development of the social productivity of labor. Marx never denied that profits could contingently fall for all kinds of reasons, but he thought there was also a structural reason for the TRPF, regardless of market fluctuations. Simply put, Marx argued that technological innovation enabled more efficient means of production. Physical productivity would increase as a result, i.e., a greater output would be produced per unit of capital invested. Simultaneously, however, technological innovations replaced people with machinery, and the organic composition of capital increased. Assuming only labor can produce new additional value, this greater physical output would embody a smaller value and surplus value, compared to the value of production capital invested. In response, the average rate of industrial profit would therefore tend to decline in the longer term. It declined in the long run, Marx argued, paradoxically not because productivity reduced but instead because it increased, with the aid of a bigger investment in equipment. The central idea that Marx had was that overall technological progress has a long-term labor-saving bias, and that the overall long-term effect of saving labor time in producing commodities with the aid of more and more machinery had to be a falling rate of profit on production capital, quite regardless of market fluctuations or financial constructions. So Marx regarded this as a general tendency in the development of the capitalist mode of production. But it was only a tendency, because there are also also counteracting factors operating which had to be studied also. The counteracting factors were factors that would normally raise the rate of profit. In his draft manuscript edited by Friedrich Engels, Marx cited 6 of them: more intense exploitation of labor, reduction of wages below the value of labor power, cheapening the elements of constant capital by various means, the growth of a relative surplus population which remained unemployed, foreign trade reducing the cost of industrial inputs and consumer goods, and the increase in the use of share capital by joint stock companies, which devolves part of the costs of using capital in production on others. Nevertheless, Marx thought the countervailing tendencies ultimately could not prevent the average rate of profit in industries from falling. The tendency was intrinsic to the capitalist mode of production. In the end, none of the conceivable counteracting factors could stem the tendency toward falling profits from production. The capitalist system would age like any other system, and would be able only to compensate for its age before it left the stage of history for good. There could obviously also be several other factors involved in profitability which Marx did not discuss in detail, including reductions in the turnover time of industrial capital generally, accelerated depreciation and faster throughput, the level of price inflation for different types of goods and services, capital investment into previously non-capitalist production, where a lower organic composition of capital prevail, military wars or military spending causing capital assets to be inoperative or destroyed, or spurring war production. Demographic factors, advances in technology and technological revolutions which rapidly reduce input costs, substituted natural resource inputs, or marginal increased cost of non-substituted natural resource inputs, consolidation of mature industries into an oligarchy of survivors. Mature industries do not attract new capital because of low returns. Also, mature companies with large amounts of capital invested and brand recognition create barriers to entry against new competitors. See also secular stagnation theory. The use of credit instruments to reduce capital costs for new production. David Harvey mentions that in the Grundrisse, Marx lists a variety of other factors that can stabilize the rate of profit, other than by crises. The scholarly controversy about the TRPF among Marxists and non-Marxists has continued for 100 years. Standard criticisms of Karl Marx's argument. Marx's interpretation of the TRPF has been the source of intense controversy, and has been criticized in 3 main ways. By raising productivity, labor-saving technologies can increase the average industrial rate of profit rather than lowering it, insofar as fewer workers can produce vastly more output. Ladislaus von Bortkiewicz stated, Marx's own proof of his law of the falling rate of profit errs principally in disregarding the mathematical relationship between the productivity of labor and the rate of surplus value. Jürgen Habermas argued in 1973–74 that the TRPF might have existed in 19th-century liberal capitalism, but no longer existed in late capitalism, because of the expansion of reflexive labor. How exactly the average industrial rate of profit will evolve is either uncertain and unpredictable, or it is historically contingent. It all depends on the specific configuration of costs, sales and profit margins obtainable in fluctuating markets with given technologies. This indeterminacy criticism revolves around the idea that technological change could have many many different and contradictory effects. It could reduce costs, or it could increase unemployment. It could be labor saving, or it could be capital saving. Therefore, so the argument goes, it is impossible to infer definitely a theoretical principle that a falling rate of profit must always and inevitably result from an increase in productivity. Perhaps the law of the tendency of the rate of profit to fall might be true in an abstract model, based on certain assumptions, but in reality no substantive empirical predictions can be made. In addition, profitability itself can be influenced by an enormous array of different factors, going far beyond those which Marx specified, so there are tendencies and counter-tendencies operating simultaneously, and no particular empirical result necessarily follows from them. The labor theory of product value is wrong, which obviates the bulk of the critique. Marginal utility theory predicts that a relatively high rate of profit attracts further investment, but each additional unit of production will generally tend to be of less utility to the market, causing the overall rate of profit to fall absent any technological innovation increasing productivity. The commodity in question will lose its appeal to investors, who will then invest in other, newer lines of production offering higher returns. As regards the first criticism, the Japanese economist Nobuo Okishio famously argued, if the newly introduced technique satisfies the cost criterion and the rate of real wage remains constant, then the rate of profit must increase. Assuming constant real wages, technical change would lower the production cost per unit, thereby raising the innovator's rate of profit. The price of output would fall, and this would cause the other capitalists' cost to fall also. The new rate of profit would therefore have to rise. By implication, the rate of profit could in that case fall only if real wages rose in response to higher productivity, squeezing profits. This theory is sometimes called neo-Ricardian, because David Ricardo also claimed that a fall in the rate of profit can only be brought about by rising wages. Intuitively, Okishio's argument makes sense. After all, why would capitalists invest in more efficient production on a larger scale unless they thought the profits would increase? Orthodox Marxists have typically responded to this argument in four kinds of ways. Capitalists operating in a competitive environment may not have any choice about investing in new technologies to keep or expand the market share, even if doing so raises the pressure for all of them to spend an ever larger share of their income on the newest technology. It may be that in the heyday of a technological breakthrough, profits do indeed initially increase, but as the new technologies are widely applied by all enterprises, the overall end result is that average rate of return on capital falls for all of them. A slight reduction in annual profit rates on capital invested due to more expensive productive equipment may not seem such a problem to business. Anyhow, if it is compensated by an increase in profit volume through increased sales and market shares, the yield on capital might decline somewhat in percentage terms, while total net income from capital employed increases. As Professor Okishio himself acknowledged, his argument is based on a comparative static analysis. His starting point is an equilibrium growth path of an economy with a given technique. In a given branch of industry, a technical improvement is introduced and then the new equilibrium growth path is established under the assumption that the new technique is generally adopted by the capitalists of the branch. The result is that even under Marx's assumptions about technical progress, the new equilibrium growth path goes along with a higher rate of profit. However, if one drops the assumption that a capitalist economy moves from one equilibrium to another, this result no longer holds. There is no real evidence that capitalist development spontaneously tends to equilibrium, since there are continuously market fluctuations, mismatches of supply and demand, and periodic economic crises. In addition, perfect competition does not exist, and corporations may actively try to block competitors in the markets.